Okay, well, thank you everyone for joining us for our 8th episode of our webcast series, Affluence to Wealth. How's it going, guys?
Oh, fantastic. Super excited to be here on a beautiful, beautiful day. Beautiful day.
Exactly. We're lucky. So my name is Sarman. I'm a partner here at P-Gate. I will also be your co-host for today. And today's topic is financial due diligence, which makes me super excited about introducing you to our special guest, Benjie Thomas, who is the Canadian Managing Partner of Advisory Services at KPMG, and he has over 20 years of experience advising some of the largest private equity deals here in Canada. With me, I've also got my business partner, managing partner at P-Gate, Aras Sahakian. He also brings over 20 years of experience in private equity and due diligence. So for those of you who are tuning into our webcast series new, we really like to keep this informative, casual, and keep a dialogue. So if you have any questions, please feel free to ask them in the Q&A box. And for those who don't know about P-Gate, what we do is we bring private equity, small business ownership to a larger audience of accredited investors by way of fractional ownership. So fun fact for everyone, Benjie and Thomas, they used to study together at Waterloo, right?
Yeah. Benjie and Ara, yeah.
Oh, sorry, Benjie and Ara, yeah, exactly.
So Ara and I have actually, known each other for the better part of 30 years then. And so, when you combine that with the 20 years worth of experience, practically, and then my educational experience, as much as the fact that we look really, really young, the reality is the fact when you work the math, we're actually much older than we look.
Yeah.
But hopefully that gets a lot of knowledge for the people that are listening. In terms of the experiences that both, frankly, Ara and I have had over the years.
Definitely, yeah. You guys do have a good skincare regime, I will say.
Not as good as yours. We have some of our classmates I saw registered for this. So
yeah, no,
I
think they're testing to see, and hopefully they come back and say they look like just they did as they did in university.
Yeah.
But I highly doubt that's going to be the case.
Yeah. So why don't we just jump into a little bit more about yourself?
Yeah, Ara and I went to the University of Waterloo, and so we're accountants by background. So I'm a CPA by trade and started in the audit practice at KPMG. And then
a fellow CPA.
A fellow. Yeah. Thanks to his nomination. So thank you, Ara, for that nomination. So friends help friends. I really started in the audit practice and then transitioned to the newly formed practice at that time in 2001, which is buy-side due diligence. And at that exact same time, private equity in Canada was at its infancy. And it was just starting to become the mature community it is today. And so I was really fortunate and blessed. And so when you think about my experience over the last 20 plus years, I've had the opportunity to advise a number of private equity investors on transactions. And so that's where my experience comes from. And I've done, large transactions and I've done really small transactions. Right. Because when you think about Canada is really a mid-market community. So lots of mid-market businesses in our country.
And I think that's actually a very interesting bridge between what P-Gate does and what Benjie advises on. Benjie advises on large deals. We really look at smaller deals. But one thing in common is they both involve due diligence. So why don't you tell us a little bit about what due diligence is in layman terms, what it means to you?
Yeah. What's the difference between audit and due diligence?
Yeah, so why don't I first kind of take the perspective from a layman's message and really tell you, what's due diligence. Everybody asks what due diligence is, and I simplify it in comparison to buying a home. And so let's say I'm buying a home from Ara, and he and I agree on the price. And let's say it's Toronto these days, so let's use a reasonable value for a price of a home. So let's say $4 million. Okay, and so we agree on buying Ara's house for $4 million. And so one of the conditions on me buying that house for $4 million is a home inspection. And so I paid the home inspector to go in. Home inspector comes in, looks at Ara's house, and comes back to me with a report. In that report, I identify that the roof needs to be repaired. The air conditioning system doesn't work. And there's some other basement repairs that are required in the house. And that might cost me an incremental $200,000 to address to get the house to where it's suitable for my liking. And so, the question I have to ask myself is, the price that I agreed with Aura, is that a decent price? And am I comfortable paying the price we agreed upon, irrespective of the things that the home inspector identified? Or I come back to Aura and I say, Aura, like, the roof needs to be replaced, the air conditioner needs to be fixed. And so, you know what? We need to renegotiate the price. Or like the home inspector identifies something like really bad, like maybe there's asbestos in the house or something like that. I don't know. But ultimately, I sit down and say, all right, I don't want to do the deal. And so in that whole story that I've articulated, I'm the home inspector on transactions. And so people hire me to inspect the business, to understand if there's any risks that they need to be aware of. And we try to quantify those risks. And then the buyer makes a decision as to whether they want to renegotiate the price, or they want to walk away from the deal, or they actually sit down and say, hey, thanks. You know what? Those things are not as critical in terms of where I see the value in what I'm buying. And so I'm prepared to move forward, even though you've identified these smaller items, because I actually stole a house at $4 million, right? And so that's distilled in a very, very kind of simple analogy in terms of what we do from a diligence perspective.
I think that's actually a great analogy, because we've seen, both Ara and I, which we can touch on later if we have time, some examples of a whole different story when you open the cover of the hood, and it's a very different story, like you said. In the house, if you see asbestos or whatnot. So due diligence is important.
It is. It's a lot more complicated than that. Obviously, it takes a special skill set, knowing financials, but also you have to be commercial.
Yeah.
And one shameless plug I'll give to KPMG is I was on the sell side of a deal. KPMG was on the buy side. And I think that's how things have evolved over the years, is that, the focus is really on the risks. And as well, KPMG was extremely commercial. So they understood what the client was trying to achieve on the deal, and they didn't focus on the frivolous issues. They focused on the main issues. And it was actually a great pleasure to work with KPMG on that, even though they're on the other side.
Yeah. And so as you talk about that, when we talk about audit versus, due diligence, I think you really touched on it. Audit is, really an opinion at a particular point in time. And that's what an audit is. And the early days of due diligence was really specified procedures and findings. And so you'd say, you do this particular step, and this is what was the outcome of those steps. What it's evolved to is a really high-level trusted advisor, commercial perspective at looking at a transaction. And we tend to spend a lot of time on two fundamental analysis, which is your quality of earnings and then your working capital analysis.
So talk about the quality of earnings. What does that mean?
Yeah, so quality of earnings is there's not a specific definition like there is net income, on a GAAP basis. And so what we do when we think of quality of earnings is you sit down and say, what is the sustainable cash flow of a business? And so really, at the end of the day, there's a whole bunch of things that impact that cash flow, right? And so simple things that don't sit in the net income line is, maintenance CapEx versus growth CapEx. Maintenance CapEx happens every year. So you need to factor in how much are you going to spend every year in cash on maintenance CapEx to keep the machines running, or whatever other sort of maintenance requirements are in that business. And so that's a very small example. But I think, when you think of quality earnings, I try to think of, what's my regular cash flow that I should be able to generate from this business, right?
Yeah, and the simple one we see on smaller deals is the owner doesn't take a salary, for example.
Or they expense their 407, their cars, and different expenses.
Yeah, so
those are add backs.
Yeah,
we
love
to see those. And we see lots of those. You see, they use it as a personal piggy bank, right? And that's natural in an entrepreneurial business, because you hopefully can gain the deductions for tax purposes, because tax is important too, because you want to be able to minimize your tax where you can, right, in a structured way. And so that is very common for us to see in owner-managed businesses, where they run a lot of personal expenses to the business. You've got family members running through the business, and so they're sitting as either employees, and you've got to understand, are they active employees and contributing employees versus non-contributing employees. We saw a business once where there were 25 gas cards that were to different family members. And so different family members, we were looking at the expenses and we could see, well, why is the expenses so high relative to the business? So, well, 25 members have gas cards.
Right,
and so,
right.
it went on to extended family members as well.
Yeah. So we've identified financial due diligence being very important. What are some key mistakes to avoid? What are some pitfalls that you've seen? And if you can provide any examples without naming names, of course.
Yeah, maybe what I'll do is, there's a couple things because we can talk about this all day, and so maybe I'll break it into different sections,
Sure.
and I'll let the two of you ask me questions as we go through. And so, at KPMG we do large transactions and we do really small transactions. So we do transactions the size that PE Gate would be looking at. And the thing is, when you look into transactions that are that size, we actually like to go to cash flow. So you always want to understand what's happening from a cash flow perspective. And so a pitfall can be, you tend to just look at the financial statements and nothing else.
Right.
I will tell you on some of the small businesses, what we do is we actually ask for the bank reconciliation statements. And so we look at every month's bank rec because the bank tells you exactly how much cash is coming in and exactly how much cash is coming out. Right. And so for us on a smaller business, we really focus on the banking statements and what's in the banking statements. And then the second thing we do in those smaller businesses is it's advantageous for us to actually just take the full file of their QuickBooks or whatever platform they're on.
RL's favorite.
Yeah, because
we get actually direct access into their QuickBooks online.
So you do that.
And the deals that they give us access, we love.
So I'm dating myself, and so my colleagues on the line are going to laugh at me because you're right. You could probably do it online, but in my day, we would go and buy the QuickBooks platform for $500 or $700, and then we would take the file from the client or the seller, and then we would import it into the computer, and then we'd have every transaction. So now I have the bank statements, bank recs, and then I have every transaction that they have entered into the business. And because these businesses are relatively small, you can really get down to a finite level of detail in terms of the type of diligence you can do. And so, the pitfalls that people run into at times is they sit and stay too high level, and you have to understand in what instances you need to go high level versus low level. And so that's an example of things that I would tell you should be considering as you think about due diligence.
Yes, and I find that the best, if you are buying a business and you're working with your advisor, it's best to know what are the risks in the business ahead of time and plan that out, because sometimes you get in a rabbit hole and you're not actually focusing on the real issues.
Absolutely.
And you'll get distracted.
So what we do in due diligence too, it's not like there is a quasi-standard set of procedures that you would think about performing, but we take a lot of time with our private equity clients and we invest time in understanding what are the key risks to them associated with this transaction, because by the time it comes to us, you have already done a certain amount of market diligence and business diligence where you've come out and identified 5 or 6 key risks that you're concerned about. And so we understand what those risks are, and we try and incorporate into our baseline procedures things that will help address some of those key issues to make sure that we can either identify that it's actually not a risk for mitigating reasons, or it is actually a risk and it's either substantial or minor from your perspective.
Thanks. And do you have some examples of some unexpected, something amusing, or
so one like I'll tell you, the gas card one is a funny example. One that I would tell you isn't as common, or things that people wouldn't necessarily pick up on. In one instance, we looked at a business, and when we looked at the business, revenue had increased quite significantly from one year to the next, and in the year that we were analyzing. So naturally, the value of the business and expectation gap was quite high because the seller wanted to get paid on the current year's revenue baseline and said that's the new baseline. And so as we peeled the onion and really not necessarily in the detailed analysis we did, but in the conversations we had with the various members of management, we identified that their nearest competitor that was 3 kilometers away from them had a fire in their facility. And as a result of that fire, in order to meet consumer demands or customer demands, the customers from their competitor had shifted to them. And so they got this, what I would say, a temporary lift in the business in terms of revenue. And we knew that that wasn't necessarily sustainable. You can make an argument that some of those customers they might be able to keep and prevent going back to the competitor, but there were a number for sure that were really strong, trusted relationships of that competitor, and they were going to lose that. So we had to do an adjustment, and we, just like the home inspector, we said, hey, you should know the revenue is really not as high as they're articulating it is. It's probably a little less. And so you should think about, all right, do you want to renegotiate this deal, or at least have a conversation with the other side with regards to what you're going to do?
Yeah, excellent. And that goes in the quality of earnings adjustment.
To tie it all
Exactly.
together,
Yeah.
exactly.
Exactly. And so
Yeah.
you see, that's one example. I'll tell you another subtle example is in these businesses, particularly at the size that you're looking at, when you go into diligence, you actually uncover that there is someone who is actually quite critical to the business. And so a key person, key man's the old saying.
Key person, sorry.
So key person risk, right? And so that person is critical, and you realize as you're doing your diligence how important that person is to the success of the business. And so in one diligence, we identified this one person, and we knew that that person was critical to the business. But then, one of the other team members in our diligence was, they happened to be they were in the washroom and they ran into one of the other management team members, and the other management team member had talked about some of the health issues that this critical person had been facing over the last 3 years, including a heart attack. And so, we went and had the conversation with our client saying, hey, are you aware that this critical person to the business has had some health issues? We recommend you put something in place to actually diligence and understand the health of this person, because if you lose this person within a year of owning this business, you could be facing some serious business risk. So that has nothing to do with quality of earnings, nothing to do with working capital, but we identified something that was a key commercial or business risk to the business.
And you've just triggered a thought that you couldn't do that virtually, right? So everybody who wants to work from home, there's a lot of people at home today, but there's certain things, right? What are your thoughts on that?
Yeah, it's interesting because when you think about the evolution of our business, and again, this goes back to 20 years of doing due diligence. When I first started doing due diligence, data rooms were paper based. They were, some of you are just going to be surprised when you hear this. They were paper based. They would be set up in hotel rooms. There would be someone that was an administrator for that hotel room. All the books and records would be set up, and there would be a big photocopier sitting there, and I'd have to sign out what books I wanted, which ones I wanted copies of, and then I had to go sit in another room and feverishly either write it down or hand input it into into our Excel spreadsheets. And then that's also where I had the management meetings. And as time has evolved and we've gone through COVID, what's really accelerated and changed the dynamic of due diligence is we're doing a lot virtually. And so we're having Teams meetings with the management team. And so we're not on site. And so we do push to at least be on site one day because we like to walk the facility. We want to see what's going on. But what's happened is what would normally be a 5-day on-site diligence is contracted to 1 or 2 days on site. And I would tell you, we will transition back to that level. Right now, we're really not because of the market dynamic and what I would say is, hybrid working and everybody's kind of perception as what the new future normal will be. But I believe we'll get back to at least being on site one day to
It's a big difference when you're there in person.
Yeah.
The problem we're facing is a lot of smaller businesses. The owner doesn't want to tell their staff what's happening, and they're not used to people coming in.
Yeah.
So it's really difficult to hide this as as consultants or advisors.
So we so you're right, that can be hard, and so we've gone in numerous times on some of the smaller transactions, and we are actually representatives of the bank, and that's the so hey, we're looking to get a line of credit, we're looking to get we're looking to put on some debt because we want to expand, and so we're bringing in some bankers to come in because of course with our sport coats and whatever we can pass off as bankers quite easily.
So, I wanted to circle back to the key person risk, because this is actually a strategy that we really focus and hone in on, because there might be a certain industry such as a refractory business that R and I might not be experts, but we do rely on the employees there. And if the employee that is retiring, it's all in his or her head. And when they retire, then we're left with a business where might have been a good price, might be a good business, but we rely on that knowledge. So when we're looking for businesses, with potential employees to incentivize them, whether it's through equity or to give them a higher, more roles within it. So to replace that key person. And if there's no key person, it's hard to buy the business. We've had to walk away with a few deals where the business was thriving, firing on all cylinders, but that's because it was all in his head.
Right.
Yeah. So and actually, there's one deal where we were on it for about 3 years, and we were relying on one of the two partners to help us with the succession. We had identified a manager that we were going to promote. Unfortunately, he got ill, just like in your example.
Yeah.
And we had to walk. It was we walked away a week before close, and part of it was the key person risk, and the other part during our diligence, we interviewed one of the employees who basically had insured his employment for life. He had done things a certain way on some machines that made sure we couldn't easily replace him.
Yeah.
And during our interview about what we plan on doing, he started already negotiating his future package.
Before we knew this, he was coming in pretending like he was the biggest deal. And then we're like, dude, you're a contractor. But then we soon found out why it's on his terms.
Yeah.
So that's when we actually we didn't want to.
It's interesting. What I will tell you, and when we've done diligence, probably one of the single biggest factors is the strength of the management team. And 9 times out of 10, when you see weakness in the management team that's going to continue, the business tends to face challenges down the road, and that's probably the one biggest area I would tell you that where we have identified weaknesses in management, that has become a challenge in terms of the success of the investment. And because what a management team is required to do is to adjust when the variables change in the market, or for the business. And so think of COVID, and how does the management team successfully adjust for that new variable relative to a weaker management team. And so I would tell you, that is probably one of the single biggest critical success factors when you look at a business.
And that's a great point. And one of our classmates, Raheem, actually made that point. He was hoping that he has a plan in place, and he wanted that documented, so in 2 years you could see how well that plan was achieved.
Yes.
And that's what we try to do in our platform when we have quarterly reports, obviously, and we have our deals are doing quite well, and we go back to those plans 3 years ago, and that was part of the strategy.
Right.
And so we look at that. So we encourage any business owner to document plans so that you could show that this wasn't just luck that we grew by this much. This was part of the strategy. And that's one thing smaller businesses don't do. They don't have the structure, the governance.
Yeah. And so, again, that ties into what we do as part of diligence. And then, if you think and broaden the spectrum of due diligence, it's evolving as the market dynamics are evolving. And so, we tend to do more technology diligence now than we have in the past, because these businesses are tremendously dependent on platforms that they might have built on their own on a proprietary basis. And so, people are engaging us more to, understand what the technology environment's like and what the risk profile is on the technology environment. And then that's naturally tying into, today I will tell you one of the biggest things we're starting to see and we're doing more diligence on is just cyber threats. And so
That's the new Cold War.
I will tell you a lot of these smaller mid-market businesses, nobody wants to admit it. And so you don't hear these stories. It's just like, on investment success, you always hear about everybody's great wins, but you never hear about their losses, right? And so same thing with cyber. Do you want to tell someone you actually got exposed to a phishing exercise? Yeah. Imagine that. Think about that. You don't want to tell someone, "Oh, we wrote someone a check for $100,000 and it went to Russia or it went to some other country through a cyber penetration," right? And so we start to do. We're tending to see the nature of our diligence expand.
Evolve. That's actually a very important point, because my background's in capital markets. I worked at JP Morgan in London, Hong Kong, and RBC, and as JP Morgan had acquired many different banks over its time, you start to see the archaic systems, the legacy systems purchased from other banks, and how they don't talk to each other. And so, and that costs a lot of time, which results in money. And when they create a proprietary system that doesn't talk well with another system, like that's something that maybe on paper is not a big deal, but when you're trading, it really does make an impact. So I can see how technology is a larger part of due diligence, and of course, cybersecurity.
Yeah. And then how's that evolving with technology? So where do you see AI? We have our next guest will be an AI expert, actually, in early July. But how's AI going to impact your work, and how has technology changed? Because I've seen your reports; they have evolved. They're more
they have.
They're much easier to read.
So they have. So I think everything evolves over time, and technology has all sorts of different implications on the business. I think when AI right now is the hottest topic on the street, and you probably looked 12 months ago or 18 months ago, and it was Bitcoin and everything that was going to happen around blockchain. And so I think we all first have to appreciate that technology, as much as everyone likes to talk about it, the evolution of it does take some time. And so you have to think about the low-hanging fruit. I would tell you first, for us, it's really about, we've really been able to evolve data analytics. And 5 years ago, everyone was talking about data analytics. But really, how was data analytics, employed to be commercially used? And I think what people didn't appreciate was, in order to have effective data analytics, you needed information organized in a way, shape, or form in a data lake that you could tap into and pull out and
to make inferences.
And whereas if the data is quite fragmented and inconsistent, you don't get the same outcomes on the insights. Like, think about financial analysis. One person's allocating something to meals and entertainment versus admin costs, and another organization is allocating it a different way. So you just call them both meals and entertainment. Now you've inferred something because you've seen them categorized in a certain way, but they were categorized differently. And so we've been able to figure out data analytics now to a point that we can really leverage it and use it effectively. AI, we're in the first two innings. So do we really know exactly how AI is going to be used? AI is going to accelerate much faster than data analytics, so that I will admit, or at least from my opinion. But where AI is going to play in the early innings is this going to play in like chatbots and how we interact with our with people. And so it's going to be an advancement of search processes. So instead of using Google search, you'll use ChatGPT or Google's new Bard system. And so, which is quite sophisticated, and I've played around with those tools, and I think they are interesting tools, but in the kind of short end of the game, they're going to be my advanced Siri or Alexa, tool versus it doing transformational stuff in due diligence at this particular stage,
And it can't replace experience meeting with the management team. For us, that's a
relationship aspect of course.
and seeing the deal. So it could help with analysis, maybe.
Yes.
But I wouldn't rely on it.
Yeah, I think it's when you look back, like when you're saying, which I'm still shocked that you'd have to check into a hotel, sign out the books, and then read it, and then when I compare it to what it is today, that's a massive jump. So that's probably
my first laptop. I don't know if you got a laptop as a co-op student. It was this big.
Yeah,
I had
it was
like a
SC20.
briefcase.
The SC20, which no one's even going to know what that is, which is the old Macintosh. You don't even know what a Macintosh is, so it's an Apple. It's one of their first generations. It was a box, and we had to carry that. And then I had another bag. I had to carry the printer. And then when we did audits, we had to carry a big metal case to store all the files and lock it under lock and key. And so, yes, everything has advanced in a way, and it will continue to advance, and it'll change the way we do due diligence. It will become more effective and efficient. I think you always have to be careful that sometimes too much information, you can get lost in it. And so you do have to step back and think about 80-20 rule, think about kind of big picture, what is this really directing us to, and know that the 20% is actually not critical and it's not going to change a decision. And when you think about data analytics, we've done tons of data analytics and diligence. And then what happens is in the early days, we would go to management and we would talk to management, and then management would ultimately sit down and say, well, we don't look at the business this way, so we can't actually answer your questions, because those are interesting insights. Thank you for that. But that we don't know how to answer.
We love the structure,
because this is how we look at the business, and we look at it at this level. And so it probably created opportunities to think about the business on a go-forward basis versus identifying massive risk today. But I think there's also a number of instances where we did identify massive risk through data analytics that management wasn't even aware of. And so I think all those examples exist there. And one of the things we probably should talk about is how is, in a post-COVID environment, especially now, how are we looking at due diligence, and what are the key kind of risks or things that we are trying to uncover in diligence today? Because I would tell you, we're seeing different things are showing up in the quality of earnings than
such as grants or like government grants.
Well, I would probably tell you, for a lot of businesses, especially ones putting themselves up for sale, is, like basic stock investing, you sell at the peak and you buy at the low. And so a lot of businesses benefited from COVID. And probably I would argue that, their demand curve or their customers' buying cycle got shifted and pushed forward. So what happened was their backlogs all got pushed forward. And so think of anything tied into home building, renovation, or CapEx. Everything got pushed forward because everyone used that COVID window to do home renovations and do any sort of CapEx, because one, debt was virtually free. And then on top of that, they had time on their hands and they were spending more time at home. And so they sat down and said, let's go buy all these products. And so think of businesses that benefited from what I would call the COVID revenue bump. And so for us, it's sitting back and saying, well, can you identify and validate whether the revenue is really sustainable, or is this a COVID revenue bump? And so we need to normalize it down. That's one example. The other thing that we look at is on the profit and loss statement and their operating spend. Think of businesses like myself in professional services. There was a window of time that we were generating revenue and we were not on planes, we weren't on trains, we weren't in hotels, we weren't in restaurants, we weren't at Raptors games, we weren't at Leafs games, we weren't at those are all savings.
You're describing your lifestyle.
Yeah, yeah, good point. And so, think of those dynamics and the implications they have on a business, and think of the fact that I had no one coming into the office, and so if no one's coming into the office, there's no paper being printed, there's no shredding company coming to pick up. Those are saving us money, and then also people are working more efficiently than they ever had before, and so all those translated to benefits for us during COVID. And like a bunch of other businesses, they generated temporary, what I call temporary savings. And so the question that gets asked of us is, what in the P&L is temporary savings, and what costs are going to come back into the system? And so how do we face that? In this economic climate, people are facing pricing pressure now. And so we've probably, we've had to pay people more, right? We've had to pay people more. And that's for all businesses.
There's a war
on talent across everywhere. Anywhere I talk to any of my friends in manufacturing, professional services, business services, there's a war on talent, and they're particularly during COVID. And so we all raised compensation to address that and address inflation. And so what happens is now you're looking at businesses where, that has been put into the system, and then you're facing some pricing pressure as margin.
And there's a wage price spiral there, and it's embedded in the economy, which central banks are very much.
So if you think about what you're going to do from a business perspective, and you've got margin erosion, during COVID they were making, let's say they were making 40% margins. Well, maybe the normalized margin is actually 35% because your cost structure has changed and your pricing power has changed.
One business we were looking at. We're going to jump into questions. We see some questions. Feel free to ask questions, but just what reminded me of one business we were looking at was involved in pallet jacks, and the freight cost for that just skyrocketed, and it was extremely difficult for them to price orders because freight cost during COVID was really expensive.
Yeah, and then they passed on the cost, and then so they did have an inflated revenue.
Right.
And exactly that, they had their best years in the last 2 years.
100%.
And then we walked away as well from that deal. Part of the reason was the working capital needs.
Oh yeah.
Right. So when we assess that, and that's what we see when it's an owner-managed business, they might have a couple of million in the bank that they haven't taken out, and that's really funding the business. And as buyers, you're not going to be able to inject a couple of million in.
Yeah.
There's so much. So
well, it's interesting when you talk about working capital. I'll tell you, our business has evolved over the years as people are looking to extract as much value as they can out of businesses today. One of the biggest things we're seeing is naturally with people carrying debt, and all of that debt in businesses traditionally being variable. And so last year they were paying, 2 or 3%. Now they're paying 5 to 7. And so, their interest expenses have gone through the roof. And so as a result of them paying maybe 3 times more in interest, they're trying to find other ways to optimize the business. And so one of the things that we do a lot of now is actually helping businesses optimize working capital to free up as much cash as you can. And that's a value opportunity in a transaction, is if you buy a business with a base level of working capital and you can, through operating efficiency and other things, drop that working capital, you're freeing cash back into the business that you can use to pay down debt or do other things. And so in a market like this, we're doing a ton of stuff around that.
So what's the lowest hanging fruit for that type of working capital optimization?
So I'm not going to profess to be an expert in this, and so I have team members that are really good at it, and so I don't know what the low hanging fruit, but I would tell you naturally it's how do you collect your receivables a little more quickly? How do you stretch those payables a little bit farther without mitigating relationships? Those are simple things, but the subject matter experts would have a better view. So I'd love to give you some sort of story, but then I'm sure my team will be calling me shortly after saying Benjie, sold.
I've got a good question here. How important is reverse due diligence? So from seller to the buyer. And actually, we're in the midst of doing that ourselves.
Yeah, you know what? So reverse diligence is really important, particularly in transactions in which you are, one, trying to confirm closing risk. So you want to identify, can these people close? Two,
right,
how much you care about your brand and the business that you've built. And
the legacy.
The legacy and usually smaller family-owned businesses, they'd like to see this business carry on much further. And so you need to be able to do some background diligence on the people that are coming to the table. That, I will tell you, part of our offering is, and we do this in diligence, and it ties to key person risk and other things, is we do individual background checks on the individuals that you're ultimately investing in. And so reverse diligence is an important aspect. A lot of that tends to be commercially oriented, and it all depends on the nature of the transaction. If you're bringing two businesses together, reverse diligence becomes really important. And so in those instances, there's usually two teams. I end up representing one, and then I usually have a competitor representing the other that's doing reverse diligence on the businesses that are going to be brought together, because you want to make sure that you create something that is accretive to both businesses versus losing value, quite frankly. And I will tell you, 80% of the time, our studies have shown that when those sort of transactions happen, value is actually lost. And so how do you make sure that you keep that value, right? And so thank you for that question. I can see it was from Jeff Stoss, who is a classmate of ours. And so thank you for that question. Jeff, it's, I hope to see you soon. It's been a long time.
Okay, and how about sell-side due diligence? Do you do?
Yeah, sell-side due diligence.
The importance of that.
It's sell-side due diligence has been around for many years. It's actually been an established practice in the UK market, and was something that took a lot of time for it to evolve and become something that is almost normal in the North American market. And it does create value in a sale process because it helps drive speed to close. And so the items that are identified in that QOV, the seller has invested in time to hire someone like myself in order to go in there and identify some of the things that would be relevant in a QOV analysis. And then, what does that mean? What does that mean to you, and how that ultimately plays itself out, right? And so I think sell-side QOV is really, really important. I think it's something we need to think about. We need to do, provides value in terms of understanding who might come to the table, and ultimately help bring a transaction to close, right? And I think there's value in that. I saw this question on the disclaimer piece. You should ask me that.
Yeah. Okay. Yeah. It was,
everybody asks.
Have quality of earnings always had a disclaimer that we can't rely on the info presented?
Yeah, that's a good question. And so here's what I'll tell you. An audit is an opinion. It's an opinion on a point in time, and it's a point in time around numbers that are attributed and tied to regulatory definitions of GAAP. Right? That's exactly what that is.
Right.
It's a point in time. A quality of earnings is not one. Quality of earnings, no one can open up a book and actually say, here is what a quality of earnings is. And I will tell you, all of the examples that we've talked about today, whether they be business related and not even attributed to the financial statements, are quality of earnings items. Like if the fire in the in the competitors' production facilities, and us and the business actually generating that increased revenue, those you can rely on those financial statements. Those financial statements, they legitimately at that point in time had a revenue increase of 20+%. But that point that we identified in our quality of earnings engagement is a business risk, and that risk is really important. And so yes, you can't rely on it, because in all fairness, I'm not going to have you come sue me because I identified a point, right? I think it's really
subjective.
It's subjective. So think about you hire commercial due diligence people, you hire strategy diligence people, and they come and say you should take the product this way, and then all of a sudden you take the product this way and you don't get the outcomes that you had thought you were going to get because they gave that they gave you that view. They have a disclaimer too. Those are standard in what we do, because we're identifying commercial sort of risks that you need to think about, and it's your choice whether you act on them or not.
And it's part of a bigger picture as well. Your report is focused on financial. There could be technical. There could be legal.
100%.
And it's up to the investor to decide, or the PE fund or us
Agreed.
to decide.
We're going to take one last question, and then we'll close it off. So, Michael Smith, thank you. I like this one. How do you determine the real value to businesses who have done very well during COVID?
Yeah, you know what? We highlighted that. We were alluding to that in the conversation. This is probably one of the most important diligence items today in terms of how we look at a business. COVID has never happened in any environment. It's new to the globe. And so, I love history as an opportunity to predict what's going to happen in the future. We don't have any history on this storyline. And so it's really important to identify where we think there are risks around COVID. And there's opportunities and benefits associated with it, because in a number of these businesses, they had so much demand come in, they couldn't get the resources. They're hiring temporary workers. You pay a premium for temporary workers. They were doing drop shipments of orders to get orders to people in time. That's a premium cost on shipping. And so you would normalize that out. But then also, I think you really need to understand what is the normalized growth rate of a business, because a number of businesses during COVID, their growth rates went to, we'll call it teens to high teen, in some, double digits with the first number starting with a 2. And I think reality would tell you that that probably doesn't seem like a realistic growth rate. And so you have to put some sort of a normalization on there. In some instances, people maybe it was a real growth rate because people's patterns of buying have changed. And so if their pattern of buying has changed, then you might have a permanent behavior in place that you can now sit down and say is sustainable. And maybe that's an opportunity for you, right? And so I think this is where diligence becomes extremely important in this window of time, because I will tell you, anyone that's selling, it's just human nature. If I'm selling, I'm going to sell you on the high. And so I'm going to sell you on whatever I gained during the business. And then, I think the converse point is, if the business is on the low, I'm going to sell you that, the reason why it's on the low is because of COVID and I'm on the up. So I want you to pay me that premium above what the numbers are running at now. And so this is why negotiations become extremely advantageous, right?
Yeah, and that's structuring. At the end of the day, we're faced that situation. We had agreed on a price. We saw that the normalized earnings were a bit lower, so we put in an earn-out structure, and which is a bit of a win-win, so that we're not paying the value up front, and if they achieve those targets, we pay more. So
yeah, great. Yeah, I agree.
Awesome. Well, thank you everyone who joined us live, and this will be available on our website on demand. Big thanks to Benjie Thomas for being here with us and providing
Thank you.
all
I
his
enjoyed
insight.
the conversation, everyone.
Thank you. Great. Thank you, everyone. Have a nice rest of your day.
Bye, everyone.